Evidence is piling up that the Federal Reserve is falling behind the curve. What would the Fed do? Would it bite the bullet, or would it do nothing? Where does the November election figure in its consideration? Between doing nothing and nipping inflation risk in the bud, which course of action is more risky? Which markets will have the most to gain or lose? Both the stock market and the bond market sold off sharply this week after a stronger than expected U.S. consumer price inflation reading for March. On a year-on-year comparison, headline CPI inflation edged up to 3.5%, the highest since last September, while core CPI inflation was unchanged at 3.8%. More concerning is the fact that on a month-on-month basis, core CPI rose by 0.4% for the third consecutive month. Wall Street certainly woke up to the fact that inflation is alive and kicking, but the inconvenient truth is that the writing has been on the wall for a while. The 3-month moving average of core CPI inflation, the orange line on this chart, shows clearly that inflation bottomed sometime in the middle of last summer and that it's been trending up steadily since. I've learned over the years that Wall Street sees what it wants to see, but there is really no excuse for the Federal Reserve that employs hundreds of economists to monitor the economy's every heartbeat. The strong inflation readings of the past 3 months have made a laughingstock of the Fed that for all practical purposes declared victory over inflation when it signaled the end of the hiking cycle last December. Hindsight is 2020. Back in December, what did the Fed see that made them think that inflation had been overcome and that they should get ready to start cutting interest rates? The Fed thought monetary policy was already very tight. After the most aggressive hiking cycle in 4 decades, real short-term interest rates were much higher than at the end of the 2015 and 2018 hiking cycle, and even higher than at the end of the 2004-2006 hiking cycle. Meanwhile, the unemployment rate that had bottomed last April was gradually edging higher. Moreover, fiscal policy stance was expected to turn more neutral in the 2024 fiscal year after the massive stimulus in 2023. There were also clear signs of credit tightening. Indeed, the Q3 Senior Loan Officer Survey found that 50% of domestic respondents tightening standards for commercial and industrial loans. Over the past 30 years, a reading of 50% and above had resulted in a recession. And then, of course, there was the bond market. The fact that the yield curve was extremely inverted and remained so helped convince some at the Fed that a recession may be just around the corner. Since the Fed's dovish pivot December, not only the risk of recession has receded, but inflation has stopped falling. What happened and why? The sharp drop in core inflation last summer was due to a sharp drop in inflation of core goods. Since then, core goods inflation has gone sideways. Prices of used cars, which had dropped sharply last year, have stabilized. Apparel inflation has also troughed as cotton prices bottom. Meanwhile, deflation of imported goods has eased. If inflation of core goods on a year-on-year basis is set to trough soon, this already happened with core services inflation. The 3-month moving average of core services inflation bottomed last July. Contrary to expectation, shelter inflation has been reaccelerating lately. Whatever is the reason for this, all I know is that shelter inflation in the inflation calculation still has quite a bit more catch-up to do with actual rent. Housing inflation gets all the attention, but rising core services inflation is fairly broad-based. For example, medical care inflation has been picking up steadily since last summer. Indeed, inflation on core services, excluding housing, has risen a full percentage point from its low in October to 4.8%, the highest level since last April. The fact that core services inflation has been so sticky should not come as a surprise. After all, core services inflation tracks wage growth closely, and wage growth has been easing more slowly than inflation over the past year. But why is wage growth so stubborn when the unemployment rate has stabilized? The obvious reason is that there are still many more job openings than job seekers. Labor demand remains strong. Most of the new jobs are created in just 4 sectors: government, healthcare, construction, leisure, and hospitality. These sectors are hiring a lot of people, but it is really the consistency of their hiring that is particularly striking. The hiring in healthcare says much about the aging population and the shortage of healthcare workers that is expected to get worse over the coming years. Government hiring is running at the highest level in 20 years. I don't have a good explanation for why this is the case. All I can conclude is that fiscal policy remains extremely lax. Strong hiring in the construction sector may seem odd given that housing starts remains pretty depressed. But construction spending in the manufacturing sector is going through the roof, thanks to reshoring of manufacturing from China and huge government subsidies for the green industry and the semiconductor industry. If I have to guess, the continued strong hiring by the leisure and hospitality sector, especially against the stagnation of new iPhone sales, reflects a shift in consumer preference from goods to services in the post-pandemic age. Government, healthcare, construction, leisure, and hospitality are all service sectors. In fact, very labor-intensive service sector. It is very possible that a structural increase in the demand for these services are the reason why labor demand and wage growth are strong. In my view, this is a major reason for why the Fed has fallen behind the curve. I've been talking about the risk of the Fed falling behind the curve for a while. I hate repeating myself, but my main concern is that financial conditions are too easy for an economy that's growing above trend with little spare capacity. There are many financial conditions indices out there, but I like the Chicago Fed's National Financial Index especially. I like it because 1, it covers a broad range of financial indicators across markets, and 2, the weight for each indicator reflects its historical importance for driving the overall financial climate. The index has eased so much since last spring that it is now looser than at the start of the Fed hiking cycle in 2022. As of last week, 99 out of the 105 indicators the Chicago Fed uses to construct this index is looser than average. In other words, only 6 are tighter than average. But it is not just the financial conditions that are too loose. The Senior Loan Officer survey suggests that banks have been easing lending standards over the past 2 quarters. Meanwhile, household debt service to disposable income ratio is still lower than at any time before the pandemic. What it says to me is that households are sitting on mainly long-term fixed rate loans, and that real effective interest rates have not gone up more than real income growth. Jerome Powell commented recently that the slowdown in CapEx spending last year indicates tight financial conditions. But CapEx spending picked up in the 4th quarter, and the latest Business Roundtable CEO survey suggests a further acceleration is in the pipeline. AI has increased the expected return on investment. The massive AI-driven stock market rally over the past year should have given the Fed pause before it signaled in December its intention to cut interest rates. Higher expected return on investments means the economy can live with higher costs of capital. In other words, higher interest rates. I think the Fed has a problem, and I suspect it knows it now after the recent string of strong job and inflation data. The million-dollar question is, what is it going to do about it? Jerome Powell has 2 choices right now. Nobody likes to admit that they're wrong, especially if you're the chairman of the Federal Reserve. Powell might decide that he needs more time and more data to make up his mind. Maybe next month, inflation will come off miraculously. While he waits, he might even comfort himself that given monetary policy works with a lag, that we have not seen the full effect of the Fed's interest rate hikes in 2023. The problem with this course of action is that the election is only 7 months away. The closer we are to the election, the more difficult it would be for the Fed, politically speaking, to change course. It is safe to assume that the last thing the Fed wants to see is inflation going up into the election. Given the inflation is one of Biden's biggest liabilities in the election, my guess is that even the Democrats on the FOMC would not want to risk allowing headline and core inflation to creep back to 4% before November. Trump will surely have a field day. And I won't even mention the risk that bond vigilantes might decide to come out of the closet. Do nothing is what civil servants do best, but do nothing in this case carries very high risk, something that civil servants hate more than anything else. This leaves Powell with a second option. Nip the growing inflation risk in the bud right away. The market is pricing one full cut and a 70% chance of another cut in 2024 right now. This means Powell will have to play down any chance of a cut if he wants to tighten financial conditions by more than a little. I would argue that 10-year Treasury yields will have to get back to 5%, like it was last October, for him to be sure that it is enough. Powell certainly won't have an easy time trying to explain to Congress why the sudden pivot. But I actually think the bond market would think more highly of him as a result. With U.S. government debt at $33 trillion and a deficit of $2 trillion, the Fed cannot afford to lose any credibility when it comes to its inflation credentials. So which path will the Fed choose? My gut tells me that the Fed will bite the bullet. If I'm right, it should help support the dollar and the long end of the U.S. yield curve. If I'm wrong, the gold and Bitcoin rallies are just getting started. Thank you for listening.
If you got something out of this program, please hit like and subscribe to my free YouTube channel.
Let me know what you think by posting your comments on the video.
If you want to learn more about my investment strategy, come visit us at davidwuunbound.com.